Hi there, welcome to Nepi Invest. One of those things I do when I do see the market down, and we are seeing the market under pressure right now, is to search for bargains. Now, not every sector will have bargains in it. For instance, financial sector, mining sector. But when we go to some other sectors, and the sector I'll be looking at today is consumer discretionary, in particular retail, we have seen the share prices of many of these companies fall off a fair bit over the past few months, even six or even more than 6 months. And so, what I'm going to be doing in this video is I'm going to go through a fair few companies within this space, and I'm just going to see if there's any value right now. And I'm going to draw up a bit of a hit list or a watch list of companies that I do like, that I do think could be value right now. And then I'll be looking at possibly buying into these companies in the future. There is also potential, particularly in this sector, consumer discretionary, particularly if we do go into recession, there could be further downside from here. And the time to buy, probably almost the exact time to buy, is if we go into a recession when the worst has been priced in, maximum pessimism, that would be the time to buy. And hopefully, if we do end up there, some of these companies will be really, really cheap. So what I'm using now is TradingView, and I've separated this into two sections. This is just because this is what you see in TradingView. So on the left, we have the chart, and I'm going to go back over 2 years prior to COVID-19 because I want to compare the valuation or the share price back then to the share price right now. I'm also going to be looking at the market cap and also the earnings of the company profit over the past 5 years, just to see if there is any value. Now, this is very crude way of doing this, very crude and quick way, but I have found in the past just doing this very quickly can work wonders to drawing up a bit of a watch list of those companies who are heading towards becoming really good value, and then you do further research on those companies. So quite a few companies I do want to get through because on this particular watch list, I do have in TradingView, there are quite a few companies, not all encompassing, not every single retail consumer company is in this list, but the majority are, particularly the big ones. So actually, we're starting off with Domino's Pizza. And this has been sort of a market darling for many years. And during the post COVID-19, up until the end of last year, the share price of this company was in a really good uptrend. In fact, the share price reached a high of $168, and that would have been in September last year. But the share price has fallen from $168 to $66.20. And interestingly enough, the share price right now is almost identical to the highs we saw pre-COVID-19. So right now, that does make Domino's Pizzas enticing. So the valuation of this company right now is the same it was before COVID-19, before we saw that massive uptrend in the share price. So the share price of this company has pulled back, but is it good value? Now, this is when it comes, this is all about subjectivity, not objectivity. So you have to look at different things in regards to coming up to the point where you can determine whether a company is cheap or expensive. And it's all about the future. If you think Domino's Pizza is going to grow at a fantastic rate over the next 5 years, you might think right now the company is cheap. If you think the growth the company has experienced over the 5 years will be similar or maybe less, then probably the company right now is still overvalued. Have heard this company being brought up a couple of times in podcasts, and in particular one podcast, this was a recommendation. Well, that wasn't a podcast. That was someone who runs a recommending service. And the reason they said this was a recommendation was because it is now cheap. And that's one thing I do query about Domino's Pizza right now is whether it's cheap. Because the markup of Domino's Pizzas is 5.8 billion. And the earnings last year was 184 million. Previous to that, it was 138, 115, 120, 102. So that means the price earnings ratio is out 33 right now with the share price 66. And that tells you when the share price was $168 in September last year, the PE ratio of this company was way too high. I'm not sure why you'd be buying this company back in September when the PE ratio would have been more like 70 or 80. That would have been totally ridiculous. for this type of company. So price to earnings ratio of 33 based off last year's earnings. Now, there is a possibility, maybe a strong possibility, that earnings this year will be lower than they were last year, which makes that price to earnings ratio a little bit too frothy for my liking. The way I look at Domino's Pizzas, if we go back prior to COVID-19, we were seeing a profit around about 115, 120 million. And with the growth this company is experiencing, so revenue is growing at a consistent rate, I'd probably say a good starting point with profit would be between about 140, 150 million. So if we give this a price earnings ratio of 20, that makes the valuation of this company around 3 billion. And right now it's 5.8. So I think there is potential downside or further downside for this company. And if I want to have sort of a safety net, I'd probably wait for this share price to fall because there is that further to fall. So right now, I would not say Domino's Pizza is cheap or good value at these prices, even though it is growing. I think there is still further potential for this company to fall. Next company is CKF or Collins Food. This owns KFC. And the horizontal line I have here is not the highs we saw post or pre-COVID. In fact, the share price has gone below that. This was just a breakout we saw in the share price back in June of 2020. And that was a really good, strong support level. And the share price is just above that support level, right on $9. And again, I'll say this time and time again, round numbers tend to be very powerful support levels or resistance levels. And we have it here with Collins Food at $9. Share price currently is $9.38. I am recording this video just after opening on June the 7th. And TradingView, I think it is delayed by 20 minutes. So these share prices won't be updating for the next 6 minutes at least. Anyway, so share price is $9.38. Revenue for this company is increasing year on year. So that's the first thing I always look at. So that's a definite tick for Collins Food. Current share price is $9.38, which makes the market cap of this company just over $1 billion. Profit last 5 years has grown from 28 million to 33 million. So not really good growth in revenue or with profit over the last 5 years. So that's one concerning thing. The other concerning thing here is with profit around about 30 to 35 million, with a price to earnings ratio of say 20, that would give a valuation of about 600 million. So the market cap right now is well above that share or that market cap I would be willing to pay. And in fact, for some of these companies I'll be showing in this video, I wouldn't be willing to pay 20 times earnings right now. It'd probably be less than that, maybe 15 or even towards 10. So at this point in time, I wouldn't say Collins Food is good value at these prices. The next company, ARB, which is also a market darling, but share price is under significant pressure. But when you equate the share price right now to the highs pre-COVID, share price is still well above. So there's still a lot of that hype in this company still priced in. The share price actually increased from about $11 all the way to a high of almost $55 at the peak in January of this year. Share price has fallen from that peak of 55 to a current share price of 31. So continue falling in the share price. There is potential for the share price to continue to fall from here. Current market cap at $31 is 2.5 billion. And if we have a quick look at the profit, again, revenue growing each and every year, so another good sign. But we saw a massive increase in profit from 2 years ago to last year. In fact, profit went from 57 million to 113 million. If we go pre-COVID, profits were around about 50 to 55 million. So that jump in profit won't continue in the next year. We should see profit fall away. So a number I'd give profit would be like 75. So again, if we use a 20 times earnings ratio as sort of a starting point on $75 million profit, that gives a valuation of this company around about 1.5 billion. Current market cap is 2.5. So I think if the share price of this company falls to the highs we saw pre-COVID, that would make our ARB a little bit more enticing. And that means we need to see share price drop another $10 from here. So again, ARB is not on my potential watch list just now because I think still more to fall, still not undervalued or even fair valued at these prices. Another company, Lovisa, is, I probably wouldn't say this is a market darling, but I have heard this company mentioned a lot. They sell jewelry, that sort of thing. So this is a company or a store I would never go into. Share price reached a low of around about $2.50 during the peak of the COVID-19 financial panic, and then a high of $23. That would have been towards the end of 2022. Share price has fallen from $23 to current share price of 14. So any good value right now with Lovisa? Let's have a look at the market cap. $1.6 billion market cap. Dividend yield, nice, 4.37%. And right now, price earnings ratio is 38. So a lot of growth priced into Lovisa right now. Revenue has grown from 178 million 5 years ago to 288. So nice growth in revenue. Well, profit has really remained steady. So if you go through profit the last 5 years, 29 million, 36 million, 37 million, 11 million, 25 million. So no real good growth in profit. So a lot of positive growth in regards to profit priced into Lovisa right now, and that's why the price earnings ratio is quite high. So again, I think unless this company really meets those expectations, there is a little bit of blue sky price into Lovisa right now, and I could see this fall further from here. Particularly jewelry, I would think jewelry would not be high on people's buy list if they are under pressure when it comes to higher energy prices, higher food prices, those sort of things. I would think jewelry comes last when it comes to purchases for consumers. Could be absolutely making stuff up there, but that's just what I'll be thinking. Majority of people would be thinking themselves. Next one is Joyce. I don't know much about this company. This is just on the watch list. Very small cap company. They sell kitchens and stuff like this. I thought they also had something to do with auctions or something. That could be another company. But anyway, small cap company, only $74 million in market cap. And currently, if you go back through the last 5 years, revenue has been quite up and down. And then last year, revenue did climb from 85 million to 111 million. So nice growth in revenue, but that just could be because of post-COVID. But if you look at profit over the last 5 years, 3 million, 3.3 million, 3.3 million, a negative 2 million. And then last year, it was 7.6 million. So we did see the share price rise considerably over the past 2 years from a low of 80 cents to a high of $4. And the current price earnings ratio is about 11.5 based off last year's profit. I think this company will fall. The profit in the next year will fall more than likely. So that price earnings ratio is a little bit too high for me just now based off last year's earnings. Dividend yield 6.6%. If they could maintain that and even grow that, this company would be enticing. So probably need a little bit more research on this company. But the very fact they actually do kitchens, that would be concerning, because I think a lot of people who wanted to improve their kitchens over the past few years had the opportunity, and I think those sort of things won't be high in demand in the next few years, particularly if we do go into a recession. Another market darling is Baby Bunting, BBN. I just think of Brisbane Broncos when I see BBN. And this company has been beloved over the past 3 to 5 years. Really good growth in revenue. In fact, revenue has grown from 278 million to 468 million. But when you look at profits, grown from 12 million to 17 million. So not good growth in profit. Margins are fairly low. You'll think margins will be pretty good in this. Dividend yield, 3.4%. Market capitalization, 576. Doesn't seem too stretched. And the current price to earnings ratio is 33. So right away, that does seem a little bit high. Share price has pulled back to just over $4, and that is right on a really good support level. And again, I just think I would like to see much higher profit to justify a market cap of 576. So if I'm talking about a market cap of 576, I probably would want profit at least $30 million. Preferably even $40 million, and Baby Bunting is well off that right now. So no interest in Baby Bunting right now at these current prices. Now onto Harvey Norman, and this could be the first company that I might put on my watch list. I probably would think this company is quite cheap at these prices, and a current share price of $4.31. That is actually lower than the share price pre-COVID. So the valuation of this company is lower, unless they did raise capital over the past few years, than it was back in February of 2020. So let's have a look at some of the numbers of this company. Harvey Norman had a really good financial year 21. You can see that in the revenue. In fact, revenue grew from 3.4 billion to 4.2 billion, and profit grew from 480 million to 841 million. So I can't price Harvey Norman based off last year's numbers. I'm going to have to go back the 4 years previous to that. So income or profit was ranging between 448 to about 480. Lowest there was 375. So if we just assume profit could be between 400 and 500 million, times that by say 10, so that gives a low bar to our possible valuation, say 4 to 5 billion. And then on the high side, you wouldn't want to pay any more than 10 billion. So right now, the market capitalization of Harvey Norman is 5.4. So that's towards the low side. So this is sort of getting or moving into interesting territory right now. Dividend yields 8%, and the price to earnings ratio based off last year's profit is 6.73. So that does seem low. But again, I think that's misleading. And if you look at last year or the previous year's profit, or then even the year before that profit, the price earnings ratio is still fairly low. So Harvey Norman is the first company I'm going to put onto my watch list. I'm just going to mark that down, HBN. Doesn't mean I'm going to buy a position in this company. I'm not a biggest fan of Jerry Norman or Jerry Harvey, whatever his name is. I don't think he's the best CEO of a company. I do think he makes decisions that suits him, not shareholders at large. Anyway, next company is a company I actually do like, and that's Nick Scali. However, my main concerns about Nick Scali is that the tailwinds they did experience post-COVID-19 are coming to an end. People wanted to buy furniture to make their home better, maybe improve their working at home situation better as well. Share price right now has pulled back from $16 to a current share, which was the high back in late 2021, to a current share price of $8.67. The highs we saw pre-COVID was around about $8.50. So share price has moved down to pre-COVID levels. So that's the first tick when it comes to Nick Scali. I probably would suggest that based off last year's numbers, this company does look quite enticing, but we did see a massive increase in revenue. In fact, revenue increased from about 250 million to 373 million, but profit actually doubled from 2020 to 2021, increasing from 42 million to 84 million. So let's ignore financial year 21, profit of 84 million. Let's go back to the previous year, profit last 5 years or 4 years previous to last year, profits went from 37 million, 41 million, 42 million, 42 million. So let's start with 42 million as a base here. So times that by 10, so that gives a PE ratio of 10. Times that by 10 gives a market cap of about 420. And then if you do a price earnings ratio of 20, that gives a market capitalization of about 840. Current market cap is $715 million. So sort of in between those two, more towards the higher end. So again, if you are of the opinion that you need a bit of leeway between the price you buy into and what's it called, margin of safety, then right now, Nick Scali probably would not be on your watch list because there is more to fall, potential more to fall. But if this does move towards a market cap of around about 500 million, even lower than that, this would become enticing. Price earnings ratio based off last year's earnings, 9.27. And no doubt, I think the profit this company will experience in financial year 22 will be significantly lower than 84 million, which means that price earnings ratio is a bit misleading. So Nick Scali is, I could put it onto my watch list, but I'm not going to at this point in time. So Myers is, instead of being a market darling, this is a complete opposite. What's the opposite of a market darling? I'd sort it's a market hater, and everyone hates this company. Well, majority of analysts hate this company. But just because this is a dying sort of sector, doesn't mean they can't make a lot of money and produce a lot of cash flow for their shareholders. So let's have a look at my holdings to see if there is any possible value when it comes to this company. I'm just going to write down Nick Scali. I've changed my mind. So I'd really like the company. Anyway, so let's have a look at Myer. Revenue has been dropping. So again, not the best quality company when it comes to revenue growth. The first thing I'm always looking for is revenue growth. Revenue has actually fallen from 2.6 billion in 2017 to 2.3 billion last year. There was a bit of growth from 2020 to 2021, and profits dropped. Well, actually, it hasn't dropped. It's gone from 12 million in 2017 to 46 million in the last year. Previous year, it was negative 172. So profits all over the place here. Now, we can't really say that $40 million of profit is typical, because if you go previous to that, the next highest profit was 24 million. So it's really hard to sort of judge what the fair value of this company is, current market cap is 348 million, dividend yield is 3.53%. Says here price earnings ratio is 9.9% or 9.9. That's based off last year's profit of 40 million or so. So at this point in time, I really have no interest in Myer Holdings simply because revenue has been dropping over the last 5 years and profit is really lumpy. They do have some good cash flow, but I think there is better opportunities out there. So Myer does not make it onto my watch list. Now to my favorite company among this consumer discretionary, and that is JB Hi-Fi. This is the shorter's bane of their existence. This has been a very popular shorting stock over the past 10 years. In fact, when I bought JB Hi-Fi back in 2012, when share price was $8, it was the most shortest stock on the ASX back then. And over the last 5 years, it has been one of the most highest shorted stocks as well. And shorters always get this company wrong. They believe Amazon is going to destroy this company, but this is one of the best run companies in Australia. They are doing everything right. And JB Hi-Fi's share price has been trading in a range over the past almost a year and a half, from November or since October, November 2020, has been trading between about $43 and $54. Share price right now is towards the bottom of that range at $45. So is there any value here right now? And I'm going to be thinking there might be some value here. Revenue has been growing at a consistent rate last 5 years. So again, first thing I look for here is revenue growth. Revenue has grown from 5.6 billion to 8.9 billion. Profits grown from 172 million to 506 million. A nice little growth in revenue and profit from financial year 20 to last year. In fact, profit grew from 302 million to 506 million. More than likely, we won't see revenue and profit exceed what we saw in financial year 21, but JB Hi-Fi could surprise. If we sort of go in between financial year 20 and financial year 21, profit 400 million, that means the price target I'd be looking for, or market capitalization I'd be looking for, is around 4 billion. If I do put a little bit of a premium here, I'd probably say around 6 billion. So anything between or anything lower than 6 billion, I would become interested in JB Hi-Fi. So let's have a look at the current market cap. And the current market cap is $5 billion. So this does fall into price range or valuation range that I'm interested in this company. Not only that, the dividend yield is 5.83%. And I think over the next 5 years, that will just grow from here. So definitely JB Hi-Fi has been put onto my watch list. And this is a company I am following quite closely. If I see the share price fall below $43, this would become a buy for or from me. Next one is The Reject Shop. I'm not even sure why I'm going to be looking at this. This is a low quality company, really low margins. And you can see the really low margins when you look at or compare the revenue to the profit. So revenue is consistently above about, we'll say 750 million. Hasn't really been growing over the last 5 years. But even though revenue is consistently above 750 million, this company has trouble finding some good profits. Profits have gone from 12 million, 16 million, negative 16 million, 1 million, and 8 million. So really low margins, not the sort of company I think is a good investment over the long term, unless they grow revenue at a good rate. Something like Costco is a good example of a company that has really low margins, but because they have significant growth, that company is a good investment, but it is highly valued right now. So at this point in time, it's hard to sort of give a valuation or fair valuation to The Reject Shop just because their revenue, even though it is stable, their profits are quite lumpy. So if you just give, say, a profit of 5 to 10 million, that means I'd probably want to pay this company when it gets to a market cap of say 100 to 150 million. And right now the market cap is 134.9 million. So probably fair value for this company. But because I do think it's a low quality company, I'd want a little bit of a discount if I am buying into The Reject Shop. So I'd probably want to buy this company when the market cap becomes less than 100 million. So I actually will put The Reject Shop onto my watch list just because it is heading, because the share price is falling, heading towards that $100 million market cap. Next one is Adairs, and I've noticed this company being put onto a few watch lists, a recommendation from a couple of advising services, and the share price has fallen below pre-COVID-19 levels. So this company could be looking interesting. Share price has fallen, something I haven't shown you yet, something I discovered the other day. So the share price has fallen a pretty big 56% from its highs we saw. How do I get rid of that? There we are. Highs we saw back in middle of 2021. Share price in a really good downtrend. Share price has gone well below the pre-COVID-19 highs, which were $2.60. Current share price is $2.19. The market has opened 10:32 right now, so it is up 0.9% today. It doesn't mean anything. Now, really, when you look at the revenue has been growing really good over the last 5 years. In fact, revenue has grown, even before COVID-19, revenue has grown from 264 to 499, almost 500. We did see that spike in revenue in financial year 21. Profits grown from 21 to 31, 29, 35, and a nice little spike in profit last year up to 64. Ignore financial year 21. If you go previous to that, profit of 35 million. So if we go back to timing that profit by 10, which gives a PE ratio of 10, that means market cap of 350. That would be pretty good value for this company. So I'll probably give a bit of leeway to that. So increase that market cap to say 475 million. This company would be looking enticing. Market cap right now is 380. So this company is looking really interesting at current levels. Not only is the market cap 380, so good value based off financial year 20 numbers, not financial year 21, the dividend yield is 8.11%. So definitely Adairs is going to be put onto my watch list. So other advising services have put this as a recommendation. So I sort of can understand that. The only thing going against Adairs right now is just the share price is in a well-defined downtrend. But I am seeing possible good value when it comes to this company. And just like many other companies in this list, I do expect revenue and income or profit to fall in financial year 23. Next one is Super Retail. This company is this the company that owns Rebel? I think it's Rebel, BFG, whatever that boating, fishing, whatever it's called. Anyway, not much to say about Super Retail. Share price has fallen from a high of about $13.50 to $9.28. We didn't see much of an increase in share price post-COVID, although share price did fall all the way down to $3.50. So you can just see how panicked people were, or investors were, during the COVID-19 financial panic. But let's have a look at the revenue. It has been growing at a consistent rate, and we did see that peak in revenue last year. And when we look at profits, it's gone from 101 million to 110 million just prior to COVID-19 or during financial year 20, and then up to 301 million. So revenue or profit almost tripled from financial year 20 to financial year 21. So we can't use financial year 21 profit to value this company. That would be a mistake. But if we can say with confidence that profit should exceed at least 100 million, or say 110 million for this company once we go back to normal in the next few years. So 110 million should give a market cap exceeding 1 billion. I'm going to say 1.25 to 1.5 billion for this company. And right now, the market cap for Super Retail Group is 2.2 billion. Really nice dividend yield, 8.37%. The other thing I've got to check is whether those dividends these companies are paying out is sustainable in the future. I think there is a possibility, a strong possibility, that some of these dividends will drop in the next few years. So dividend yield 8.4%. And price to earnings ratio 9.4 based off financial year 21 numbers. So Super Retail Group is a little bit too expensive just for me at these current prices. But again, share price is falling. And if it falls, say to $7, this company could be way more enticing for me. Beacon Lighting, BLX. This company was more talked about coming towards the end of financial year 21. A lot of chatter about Beacon Lighting. You just see that with the share price and the chart. In fact, the share price increased from 38 cents all the way to a high of $3.38. So this was almost a 10-bagger from the depths of the COVID-19 panic to the share price high towards the end of financial year 21. But the share price has been pulling back, just like most other companies on this list. In fact, we haven't seen one company yet that is not in a downtrend right now. The share price has moved down from $3.38 to lower than $2, and that's share price is now has fallen 1.72% today. So let's have a look at the value of this company, see if it is enticing. Revenue has been increasing over the last 5 years, a tick. Profit has gone from 16 million all the way to 37.7 million last year. If we go back to financial year 20, it was 22 million. So if you use that as a base, if we use 22 million as a base, I'm going to look at, say, a rough estimate of about 250 to 300 million as good value when you're using a margin of safety for this company. And right now, the market cap is around 438, dividend yield 4.5%, price to earnings ratio based off last year's numbers, 11.5. So this has a little bit more to fall from here, a little bit higher risk than some other companies like Adairs, JB Hi-Fi, and Harvey Norman. So Beacon Lighting is not onto my watch list. McPherson's, I'm not sure if this is or fits into this category. They do manufacture products, so this could be more of a manufacturing company. It's described here as a consumer non-durables and household personal care in, what's this thing called, Trading View. This company's share price has absolutely fallen. It was actually falling, was that falling prior? No, it wasn't falling prior to COVID-19. It really fell towards the end of 2020. In fact, the share price fell from $3.38 all the way down to $1.12 in a few months and has continued to fall since then. In fact, share price right now is at 77 cents. Market 100 million. So let's have a look at the revenue. Revenue actually has been dropping over the last 5 years. That's not a good sign. And when you look at profit, it's been very lumpy. In fact, we've seen a few years where it's been unprofitable. Really hard to judge good value for this company. Right now, could be overvalued, could be undervalued, depending on the future of this company. And with revenue dropping, I'm not going to even think about putting this onto my watch list. So McPherson's a wide pass at this point in time. Shaver Shop. This was a buy for me. I held it not long enough. I took profits and the share price kept on increasing. Now, I actually did use Shaver Shop services in May or June of 2020. So I was one of those people who went into a Shaver Shop to buy a product to shave my hair. Anyway, revenue has been climbing. So first thing here is tick. Revenue's grown from 145 million to 215 million. And it's actually been growing quite consistently. So it doesn't seem like there was that post-COVID pop when it comes to revenue for this company. And profit, it's gone from 9 million, 7 million, 7 million, 10 million, up to 17. So there was a little bit of a pop, I think, in profit. So if you just discount or exclude the profit last year, 17.5 million, I'm not sure if I completely trust that. If we go back to the profit in financial year 20 of, say, 10.4, maybe make that 12 million. So P/E ratio of 10 gives a market cap of 120 million. Current market cap of Shaver Shop is 132. So at this point in time, Shaver Shop actually does look pretty good. And if they can continue to grow like we've seen, maybe we'll see revenue and profit come back a little bit this year, which is my expectations. But if they go back to growth, market cap 132 looks pretty good. I'm going to put Shaver Shop onto my watch list because of that. I don't think it's all that expensive. And really, the share price hasn't fallen all that much. So unlike most other companies, which are in well-defined downtrends, you can't really say that with Shaver Shop. So the market actually likes this company a fair bit right now compared to other companies I've featured in this video. Michael Hill's Jewelers, another company I owned for a short period of time, then sold to take out profits. Again, that was a mistake because the share price has continued to climb, but it does look like the trend and sentiment is shifting for this company. Current share price is now below $1. Got as high as above $1.50 towards the start of 2022. When you look at the revenue, it's just going sideways. And revenue has not climbed or risen at all. In fact, it's gone from 551 million in 2017 to 556 million last year. And there was a massive drop in financial year 20. Profit's gone from 33 million to 45 million, so high margins. I'm not sure about this company, even because it's not really growing, though I have heard there has been some good growth in international markets. This is an international company at this point in time. Again, jewelry, and just like that other jewelry company I was talking about, I'm not sure about how consumers will purchase jewelry if they do find themselves in financial stress. I would assume, and this could be a really bad assumption, that jewelry will be put at the bottom of the list. However, if it's people buying jewelry for other people in regards to presents, maybe that's a different story. Anyway, if we look at the current valuation, fact, instead of looking at the valuation, we'll go look at the income, sort of what I would expect, say $30 to $40 million. I'd probably pay this company when it has a market cap of say 300 to 450 million, and the current market cap is actually 408 million. So actually in the ballpark of when I might think about buying into this company, but I think I'd have to do a lot more research in Michael Hill Jewelers. But with the share price falling back, there is a potential the share price could fall a lot further from here. Dividend yield 6.2%, price earnings ratio based off last year's earnings 9.5%. So not the worst company I featured in this video, and not the best company either in regards to valuation. Now on to premium investments. And this is, I'm going to say, without even looking at anything, this is probably overvalued right now because this is a beloved company on the ASX, a market darling when it comes in this sector. A lot of experts would probably point out to this company as being the best company in this sector, mostly because of Smiggle, maybe even Peter Alexander. But those are their two big brands when it comes to this business. Premium Investments was in a nice uptrend until the start of this year or towards the end of 2021. Share price reached a high of about $32 and current share price is 22. So nice little pullback. But does this pullback represent value? Is there now good value in Premium Investments? Good growth in revenue over the last 5 years. It's grown from 1.1 billion to 1.4 billion. Profits growing from 105 million to 271 million. If we dismiss what happened last year, because that profit was significantly higher than we've seen in previous years, if we assume profits would be about, say, 125 million, which is a little bit lower than we saw in financial year 20. So we'll say 125 to 150. In fact, we'll say 150 million. So the price I'll be probably, or the market cap valuation I'll be willing to buy into Premium Investors would probably be around about $2 billion right now. Current market cap is 3.6 billion. Dividend yield is only 4.1%. Price earnings ratio based off last year's earnings, 14.5. So again, I think there's still a bit of premium being applied to Premium Investments because this is a highly fancied company in this sector. And I think there is a bit of premium we will have to pay because of that. Premier. Anyway, next company is Shiro Holdings. They make barbecues, kitchens, definitely barbecues, because I remember an ad with Heston Blumenthal. He was cooking something on a barbecue, and that was Shiro Holdings, I believe. We can actually confirm that. If I can just get rid of that. Shiro Holdings engages in the marketing and distribution of kitchen appliances and consumer products. It operates through segments. The kitchen appliances and consumer products. Doesn't say anything about what's the thing I was talking about? Barbecues. Anyway, the first thing we're going to look at here is revenue. Revenue has not really been growing over the past 5 years, really stable. So nothing too enticing when it comes to this company. And profit, when you look at profit, it's been hovering around between, say, about $10 million to $15 million on the high side. So if we just go to 10 million, that gives a market cap of willing to pay 100 million, maybe a little bit more than 110 million. Current market cap is 79.3 million. So I think there is a bit of discount applied to this company because I think probably a bit of risk involved in Shiro Holdings. I will put this onto my watch list just because market cap does seem a little bit low, $76 million, particularly if you go back to financial year 20, net income 6.5, and then previous to that was 7 million. So we're looking at a P ratio of around about 10 based off financial year 19, financial year 20 numbers. And if they can sort of get back to say $10 million of profit on a consistent basis, market cap of 79 million does look really cheap. Retail Food Group, I'm just going to ignore that for now because that needs to really rebound, and I'm not really thinking we could get anything from their numbers right now because of the troubles they've had in the past. The next one is Accent Group. This is Foot Locker, stuff like that. They have a lot of shoe stuff. Anyway, share price of this company has dropped a lot, seems like. We can go back to my little thing I discovered a few days ago, see how far the share price has dropped. It's dropped almost 60% since its highs. So you just see this has been a common theme of a lot of companies in this list. Share price has dropped a lot. And share price right now is $1.34, well below the highs we saw pre-COVID. So just based off that, this company could be looking exciting or enticing. Revenue has been growing over the last 5 years. So for some reason, the market doesn't like this company right now, even though revenue has been growing. I would suggest profit has been growing as well. Profit's gone from 29 million all the way to 77 million pre-COVID, or financial year 19 and 20 numbers. We saw a profit around about 54 and 56 million. So if we use 60 million as a base here. So 600 million is a price to earnings ratio of 10. Price to earnings ratio of 20 would give a market cap of 1.2 billion. So I'd probably say anything less than about 900 million would make this company a little bit enticing just because of that revenue growth. Current market cap is 723, so well below 900 million and closer to 600 million. So giving that market cap or a price to earnings ratio of nearly 10. It says price to earnings ratio is 19.35 here. So that's net income of 76. So that's wrong for some reason. I'm not sure what's wrong there. If you have income of 77 million, yet the market cap is 723 million, that sort of implies the price earnings ratio is actually less than 10. It says here 19.35, so it could be missing something. This could be, it says here trailing 12 months. So that price earnings ratio could actually include half yearly numbers. And I haven't looked. I have not looked at half yearly numbers. And that's why there could be a discrepancy here. But based off financial year 20 numbers, financial year 19 numbers, this company is looking enticing right now. So I'll put AX1 on my list. Vita Group, I'm going to ignore Vita Group because they were the Telstra, although were the company that ran Telstra shops, and Telstra are being fairly, I should be nice here. I think they're being a little bit arrogant in assuming they can run those Telstra shops as well as Vita Group or Vita Group. I don't think that's the case. I think eventually they will understand that having a third party run Telstra shops was probably the best scenario. I'm going to ignore Vita Group for now because that company is completely different. Now on to City Chic, and this is a company that has been a market darling. People love this company for some reason. They sell clothes to overweight women, or is that the right way to put it? To big plus size women, maybe that's the right word. And we have seen a major sell-off in City Chic's share price. It's actually gone down from $6.80 to a current share price of $2.16, and that's a major drop in share price. So that share price has dropped almost 70% since its highs. And one of the reasons behind that drop is this company was way overvalued. And we can just see that in the numbers. And the share price right now has actually gone below pre-COVID levels. So let's have a look at the valuation right now to see whether there is any good value in City Chic. So if we go back through the last 5 years, revenue has been growing. So the one really positive thing about this company is the growth in revenue. It's gone from 125 million to 258 million. Even the last 2 years, financial year 19 and 20, we were seeing good growth in revenue. However, profit's gone from being negative 8 million to 22 million last year. The two previous years was 15 million and 6.9 million. So just take the last 2 years as a base, and I'm going to say, we'll say profit could get to 20 million because of that increase in revenue, 20 to 25 million. So if you use my 10 or price earnings ratio of 10 to 20 with say $20 million of profit, that would give me a range of between $200 and $400 million markup. Then I'm willing to have a look at this company. Current market cap of this company is 531. So even though we've seen a significant drop in share price, this company is still, if you use a margin of safety, still a little bit overvalued to what I would like. Even the price to earnings ratio based off last year's numbers is 25. So even though this is a market darling or has been a market darling, that market darling status has been, I won't say dropping, it has been, it's gone. I don't think this is a market darling anymore. And you can just see that with the share price drop. Mosaic Brands, I'm not sure if I should touch upon this company much because the current market cap of this company is 50 million. And even though this company has seen revenue well above $700 million the last 3 years, they're very low margins. This company, you just see the chart, share price low during the COVID-19 financial panic was around about 25 cents. We saw no significant recovery in the share price. And you can see the share price well below or pre-COVID-19 was as high as $2.50. So this company has not recovered. really low margins. The share price right now is 44 cents. No reason at this point in time to be excited about Mosaic Brands. They have to show they can increase their margins. So leave Mosaic Brands off my watch list. Now to Dusk Group. This company is exciting. So I did buy into Dusk Group way back on 29th of December. There was a profit upgrade. Share price increased that day 12.8%. I bought in at $1.98, and share price went from $1.98 to above $4. So it increased or doubled in price. And then as soon as I saw the sentiment shifting, I decided to take profits. And the share price has now fallen below where I bought back in December 2020 and is falling towards the price this company IPO'd. So they IPO'd late in 2020. I would suggest right now, without looking at anything, there is probably some potential really good value when it comes to this company. You can see a really good increase in revenue over the last 5 years. This company is growing, and just like other companies in this list, I'm going to ignore financial year 21 numbers. They saw revenue of 148 million and profit of 22 million, which would make current valuation of this company absolutely ridiculous. If you go back to the previous year, revenue of 100 million, profit of 9.5, and the year before that, revenue of 86, profit of 2.7. If we just assume a profit of $10 million, and then we apply some of my little price earnings ratios of between 10 and 20, so I'd be willing to pay between about 100 million, $200 million for this company. Current market cap of Dusk is 118.6. Dividend yield, 10.5%, more than likely, because I think financial year 22 numbers will be lower in regards to profit. That dividend will come down, which means the dividend yield will come down as well. Price to earnings ratio 6 based off last year's number. Now, if they maintain last year's numbers moving forward, say not next year, but the year after, this company is looking awfully cheap right now. So I'm going to put Dusk onto my watch list. Another one. Universal. I was walking through Brisbane CBD, and there's another Universal store opening, and this company's chart looks really interesting. We saw a reverse V shape. So this is almost a mountain, a double mountain. Share price went from $4.20 when it IPO'd all the way to a high of $8.60. So another company whose share price doubled because of tailwinds. But since that high of $8.50, which was reached towards the end of 2021, share price has dropped from $8.50 all the way down to $4.05. So I would assume this is a growing company. And based off the revenue, last 4 years, revenue has climbed from 112 million to 210. So it's almost doubled. Profits climbed from 9.1 million to 24.4 million. If you discount or discard last year, go back to the previous 2 years, you had profit of about 14 million and 13 million. So if you just assume profit about 15 to 20 million moving forward, that would give a market cap I'm willing to pay for this company, say between, we'll say 150 to about 300 million. Current market cap is 309 million. So with the share price falling, it's fallen another 3.8% today on June 7th. This company is looking more interesting. I'm going to put it onto my watch list just because I think with the growth in this company and potential growth moving forward, this company is looking interesting at these prices. Adore Beauty, I'm going to ignore this company because there's no profits. So it's really hard to sort of gauge where this company could be seeing, where you could find some good value with this company. And with the share price and sentiment absolutely being smashed right now, share price $1.24. We did see highs around about the time it IPO'd of more than $7. So you can just see massive decrease in share price, massive decrease in valuation. Market cap is just above $100 million right now, $128.9 million. And even though revenue has been climbing over the last 5 years, this company is not profitable. They need to turn that growth in revenue into profitability for me to even be interested in this company moving forward. Booktopia is an interesting company for the very fact that I think the market expects this company to go bankrupt based off valuation. Market cap is less than $50 million right now, even though revenue has been climbing. So revenue last year was 224 million, but this company has had trouble being profitable or showing profitability. So you can see the last 3 years before last year, profit of 1.6 million, profit of 8,000, profit 196,000. So just like Adore Beauty. I need to see some profitability before I get excited about Booktopia. And just the massive amount of negative sentiment in this company, share price just keeps on dropping. There would be a lot of investors who bought into this company over the past 4 months since, well, not 4 months, very longer than that. Share price high for this company was reached in August last year at $3. And we can just see the share price dropping since then. There would have been a lot of times when the share price was dropping that consumers and investors saw possible value here because the share price was significantly lower than the high of $3. And they've just bought into a falling, dropping knife. And you never want to catch a falling knife because you can cut yourself quite deeply. So I actually do have Booktopia on one of my watch lists. That is a turnaround story. I need to see this company turn around before I become interested because this could fall all the way to zero. You never know. Doesn't mean it will. TTA, I'm going to ignore that company. Globe is interesting. We saw massive growth in revenue last year from 151 million to 266 million. Massive growth in profit from 6 million to 33 million. If we ignore, again, financial year 21 and go back to the previous 4 years, profit ranged from 5 million, 8 million, 8 million to 6.1 million. So if we just assume the profit moving forward could be around about 8 to 10 million, that would give a market cap I'm willing to pay for this company, say between 100 and 150 million. Current market cap is 206 million. I think there's a little bit too much froth built into valuation and share price of this company based off last year's numbers. Now, if they can maintain the momentum of last year moving forward, which I do doubt, and then this company does look cheap at these prices, but I do doubt they'll be able to continue that momentum. Not even sure what this company does. I've talked about step one. This is a horror story. This is definitely a possible turnaround story from here because of the massive growth in revenue, but I would need to see the turning around before I become interested in this company. Markup at 55 million, which does look possibly enticing if they can turn things around. Big question mark around that. Cettire. I'm not going to really talk about Cettire much because they're not profitable. Another company that has seen their share price absolutely destroyed. I probably should say another unprofitable company that has seen their share price absolutely destroyed. Sort of like Adore Beauty, even Booktopia, share price has dropped 90% since its highs at $4.76, which was reached in late 2021. So nothing to like about this company except the growth in revenue. Really impressive growth in revenue. We've gone from 5.7 million, 22.8 million to 92.4 million. But during that time frame, they have not been profitable, or if they have been profitable, it's on a low base. On to Wesfarmers, probably the biggest, highest caps consumer discretionary company, Wesfarmers. They own Bunnings, Target, Kmart, Office Works. They also own a lithium miner. Kidman used to own that, and that's going to go into production within a few years. And they do other stuff as well. Anyway, Wesfarmers, let's have a look at Wesfarmers. No surprise to see share price dropping. It's fallen from $67 to current share price of $46.50. So let's have a look at the valuation of this company. Now, if we go prior to last year, financial year 21, we see profit ranging from 1.2 billion, 2.4 billion to 1.7 billion. So if we say 2 billion as a rough number, sort of the profit we can expect to see over the next few years, maybe we can be generous and say 2.5 billion. So 25 billion to 50 billion. I'm going to say 40 billion would be a nice number here for me to get interested in Wesfarmers. Currently it's 53.5 billion. So not much more to fall from here before I become interested in Wesfarmers. Not a high dividend yield, 3.6%. Price earnings ratio based off last year's numbers, 24. So I am starting to get interested in Wesfarmers, and the more this can fall from here, say if it fell to $35, I would become interested in Wesfarmers. And the share price lows we did see for this company during COVID-19 was around about $31. So heading towards the prime price, I would be willing to buy Wesfarmers. So not there yet for this company. Bapcor. I actually did own Bapcor, but then it moved into a downtrend. And the reason I bought Bapcor was for the wrong reasons. And I'm learning my lessons when it comes to these companies. I think I bought into this company because the share price did drop a fair bit. You can see share price dropped, what was that, towards November, because of some problems with the CEO. CEO resigned, or he was going to resign. I think this is the company. He was going to resign in a few months, and then he resigned immediately for some reasons. Share price dropped 9.5%, then 4.2%, and share price has moved or is in a well-defined downtrend right now. It was trading in a range, no longer trading in a range. So let's have a look at the Zenny Valley with Bapcor. Revenue been growing, so that's good. If we go back to financial year 19 and 20, look at the profit, a profit of 97 million and 79 million. Last year was 119 million. So if we just assume profit could be 100 million moving forward over the next few years, and again, this is really crude way to do this, but it does work. It does give you an idea of whether a company is heading towards being overvalued, undervalued, or even fair value. So if you look at that profit of 100 million, apply the 10 to 20p ratio to it, we're looking at 1 to 2 billion. I'll probably say 1.5 to 2 billion. You saw the buying price, I might think. Current market cap is 2.1. So a little bit on the high side right now with Bapcor. Dividend yield 3.4% and price to earnings ratio of 19.5. So still a little bit of a premium built into Bapcor's share price at this point in time. So no rush to buy into Bapcor. Briscoe, I'm not going to talk about Briscoe. You can just see the chart for Briscoe. It's very liquidly traded, so no point that. Kathmandu, they've changed the name now to KMD Brands. I will always call this company Kathmandu. So they bought into, what's that surfing company? I forget what it's called now. It's not, I completely forget. I can see the symbol. They bought into Kathmandu. Kathmandu bought into that surfing company, Gear Surfing. It doesn't say here. Anyway, it doesn't matter. They bought into one of those popular surfing brands. And this company has not done really well over the past few years. You can see a massive drop in share price pre-COVID to during COVID. So share price pre-COVID reached $2.38. Share price has not got nowhere near that since then. So this company has been really unappreciated by the market. This company has been really affected by COVID-19. So Kathmandu sells clothes you might buy if you're going to overseas on trips. And because people haven't been going overseas on trips, they haven't been buying Kathmandu products. But maybe there's some good value here. Not sure if we can look at the revenue growth because Rip Curl, that's what they bought. So Rip Curl, with that acquisition, has led to a really good growth in revenue. Profit is around about $50 or $60 million last year, $7 million the previous year, $55 million previous to that. So if we assume, and this is really big assumptions when it comes to this company, they could get to profit back to about $50 million on a consistent basis, maybe not this year, but maybe next year, $50 to $60 million. If we use my assumptions with the PE ratio, I probably would buy this company if the market cap got down to, say, between about 500 to 750 million. Right now, the market cap is 762. So this is very close to being put onto my watch list. In fact, I'm going to put this onto my watch list. The only thing concerning me about this company is just the lack of interest over the past few years. But with travel coming back, this could be a contrary play. And with the share price falling all the way down to, what's the share price now? $1.08. We haven't seen the share price this low for 2 years, almost 2 years. This is looking interesting. If the share price gets to, say, 80 cents, I would be really interested in this company just based on valuation. And they do have that acquisition of Rip Curl. Temple and Webster. If we go back many, many years, I nearly bought this company when the share price was like 10 cents. But who would think that online furniture company would succeed? Well, Temple Webster showed that to be wrong. They succeeded. But the tailwinds this company has experienced is falling away. I don't think many people will be buying furniture online much more. There will be still some people doing that. Share price has dropped to pre-COVID levels. So all those tailwinds that were priced in have now been priced out. And that's why, even though those tailwinds are no longer there, the share price is reflecting the lack of those tailwinds, with the share price falling to pre-COVID-19 levels. Now let's have a look at the growth in revenue. And again, we've got to discount the growth in revenue over the last few years because that's because of those tailwinds. Profit, fairly low margins. Profit has ranged from 3 million, and last year was only 14 million. So you are paying a massive premium for this company. You're assuming this company is going to grow at significant rates over the next few years. And that's why the markup is 539 million. So I'm not willing to buy into this company right now. Price earnings ratio is 65. I still think there is a lot of future growth that this company has to show before it justifies current valuations. So no interest for me. Kogan. Not only has this company's share price gone much below, well below pre-COVID-19 levels, it has now fallen below the depths of the COVID-19, and that share price is around about $3.50. Current share price is $3.54, fallen another 7 cents today. Really good growth in revenue, so that's not the problem with this company. It's just been management decisions over the last few years, which has led to a decrease in profit. If we go back to the 3 years before last year, we had profit of 14 million, 17 million, 27 million. If this company can get past this COVID-19, sort of, won't say COVID-19, we'll say these short-term headwinds, and they could be medium-term. If this company can get past these short-term headwinds, and then they can show they can grow profit again back up to say $20-25 million a year and maintain that profitability moving forward, that means I would be willing to pay, say, a tribute valuation for this company of about 500 million, because I think 20 times or price to earnings ratio is attractive for this company. Current markup is 391. So this is definitely in good value range if the company can turn things around. And I think there is a good chance they will. And the reason why the share price has been dropping is just the negative sentiment in this company and just some of these bad decisions management have made over the past few years. So Kogan is definitely onto my watch list in terms of value. RBD, I'm actually going to ignore RBD. That's a restaurant brand. And there's nothing on the chart. So I've never actually looked at restaurant brands much. In fact, I'm going to delete it from this list just because the lack of trading in that company. Redbubble, I'm not sure I should even look at this company. Really good growth in revenue. They're going to become loss-making again. You can see income last year, 31 million. So if you just ignore everything about this company, just looked at the profit last year and the revenue, you'd say this company is dirt cheap because profit of 31 million, markup 259 million, which means the P/E ratio is less than 10, but that's really misleading for this company. So just listen to what the market is telling you. This company had some tailwinds, and those tailwinds have dried up. Now this company is facing a lot of headwinds, and that's why the share price has fallen from a high of $7.25 to a current share price of 92. Probably is a good time to buy this company. I don't think that's just yet because of that negative sentiment. Now, on the opposite side of the coin, we have Supply Network. This share price of this company has been going up, and this might be one of the only companies where a downtrend hasn't really come to fruition. Share price has still been increasing, although over the last, say, 3 or 4 months, share price has been going sideways. Fair bit of volatility in the price of this company, simply because there's not a lot of liquidity. Now, let's have a look at the valuation. Revenue has been growing over the last 5 years. It's gone from 97 million to 162 million. Fairly low margins. Profit's gone from 7 million to 13.8 million. Last year, it was 9.6. Previous to that was 8.7. If we assume income, say 10 to 15 million, some good growth there. So I will pay a little bit of a premium. I'd probably be willing to pay, say, between $200 and $400 million in terms of markup for this company. Current markup is 406 million. So it's just above my threshold. So if I do see the share price fall for this company, say from a current share price of $9.94, if it fell all the way to $5, which is a possibility, if the market absolutely tanks it, this company would become enticing. I'm not even sure what they do, because I haven't really done any research into Supply Networks, but whatever they're doing seems to be working. Best and less. Not sure much to talk about this company. I've only been listed, or been listed a little bit longer than I thought. It's almost been 6 to 8 months. Share price is sort of very identical to Universal. Share price went up and then it's come back down, and it's moving towards the IPO price. Current market cap is 318 million. Revenue last few years, not much, hasn't grown. It's around about 600 million, and profit has gone from 8.7 million to negative 17.4 million to 81 million. So very lumpy. Not sure we can really trust that profit of 81 million last year, because that would give the price earnings ratio of this company 4.4% or 4.4, and that's not realistic. So at this point in time, I'm going to ignore Best and Less right now. I don't think it's the highest quality company. Oh, and the last company, Corvest. And this is probably one of the only companies that is still in an uptrend when it comes to these retail discretionary companies. Not sure if this does fall into retail discretionary. Might have to look into that. This could actually fall into another group. But this company does look enticing at the moment. Continual growth in revenue. Now, this company has been around for a long time. So these growth in revenue has only been a short time. This company has been listed on the ASX. It's been listed on the ASX for something like 50 years. Something ridiculous like that. It doesn't say. The company was founded on February 4, 1970, and I'm pretty sure it's been listed for about 50 years. And right now is the only time in its life we have actually seen some really good growth. And let's have a look at the growth in revenue. It's gone from 44 million to 69.8 million. Profit's gone from negative 1.6 million, 1.4 million, 2.9 million, 4 million, 6 million. So even the profit's been growing through time. So if we look at the profit and say, well, maybe they can continue this momentum going, and the market's actually thinking that just by looking at the chart, they think this company won't be affected by the decrease in discretionary or consumer spending. And that's why the share price has not been dropping. So if we assume they can actually increase profit to say $7 or $8 million over the next few years, that would give a possible buying price, say market cap of around, I would say 100 million. Anything less than that would be enticing. And the market cap of this company right now is 88 million. So that's why this company is looking interesting. So I'm going to put this company onto my watch list. And I've been following this company for a long time. And I've thought about buying into this company. And really, I should have, because the share price keeps on increasing. You can see the share price is volatile. You go back through the last 2 years. So there has been times the share price drops a fair bit. I think that's what you need to do with this company. If you do see the share price drop a fair bit, like we saw in March 2020, we saw in March 2021, again in September 2021, and then again at the start of this year, the share price dropped from $8.20 to $6.60. Those are the time to take a position in the company. Right now, share price is $7.64. So interesting levels for Corvest. So that's all I have for this video on looking at discretionary, consumer discretionary companies. I've drawn up a watch list of about 15 companies. So Harvey Norman, JB Hi-Fi, Nick Scali, Adairs, Shiro, Accent Group, Dusk, Universal, Shaver Shop. I've got the Retail Shop here, but I'm pretty sure I do not have that on my list. Michael Hill Jewelers, Kathmandu, which is KMD Group, Kogan, and Corvest. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 companies onto my watch list. Now, I'm not going to take a position in these companies right now. The closest I am is JB Hi-Fi. If that does fall another few dollars, that's when I might take a position in that company for the long term. And there's few other companies here that I am gaining a little bit more interest in just because I have done this video today. So if you do have any questions about my process or about any of these companies in this list, just leave a comment in the comment section of this video. This is probably my longest video I've ever done. It's gone well over 1 hour. So I hope you've enjoyed it. Hope you've taken something away from this video. That's all I have for today. I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. See you later. Bye.